everyone, you're watching Explore to Shine with Anu.
Before proceeding to the video, please take a moment to subscribe to my channel if you have not yet done, and also hit the notification bell so you will be notified when we upload a new video. With no further delay, let's quickly dive into this video.
This video is the second session of Tally, and in this session we are going to learn about journal entries. But before moving to journal entries, it is very important to know the terms used in accounting, the classification of accounts, and the rules of various accounts. So before moving on to journal entry, let's have a small recap of last session. So first, coming from the term called transaction. So what is transaction? It's an event that affects money is called as transaction. So every financial change in the business, that is whenever money comes inside the business or whenever money goes outside the business, it's called as transaction. So what is accounting? As we said, Tally is an accounting package. So the term accounting, what does it mean? It is nothing but recording, classifying and summarizing the business transaction. So we know what is transaction, an event which affects money. Whenever any event affects money, that is being recorded. Recording means entered. Then it is being classified. Classified means grouping of similar entries. And then summarizing. Summarizing means preparation and presentation of your financial statement. So the main purpose of doing accounting is used to prepare this financial statement. So the next term, proprietor. So what is proprietor? Proprietor is also called as owner. Who is a owner? A person who invests money or money's worth into the business is called as proprietor, and he is a person who bears all the risk. And next, coming for the word called capital. Capital is nothing but the money or money's worth invested by the proprietor at the time of starting the business. The next term, drawings. So drawing is nothing but the money or money's worth withdrawn by the proprietor for his personal use. When the proprietor takes money or any other things from the business for his personal use, then it is called as drawings. So what is asset? So asset are resources, properties or things which has been owned by the business. All that has been owned by the business, you say it is an asset. So asset is that puts money into your pocket, you can say. Liability. So liabilities are rights of outsiders against the business concern, or you can say even the amount due from the business to the outsiders is also called as liability. So liability always takes the money from the pocket. Next term is debtor. Who is a debtor? Debtor is a person who owes money to the business. That is, a person, one who has to give money to the business is called as debtor. So why he has to give money? Because he will be receiving some benefit from the business, or he would have been purchased something from this business. So he has to pay the money. So that particular person who has to pay the money is called as debtor. And who is a creditor? Creditor is a person to whom the business has to pay the money. So why the business has to pay money to him? The same thing. So business will be receiving some benefit from that particular person. He'll be rendering some service to the business, or he has sold some goods. So that's why we have to pay money. The business has to pay money to him. So that particular person to whom we have to pay the money is called as creditor. The next term is goods. So what is goods? So goods can be anything. It can be any products, it can be any articles, it can be any things with which the business deals. Like for example, suppose if I'm purchasing computers and if I'm selling it, for me, computers are goods. And the same thing in an textile shops. Only clothes are goods for them. So next term, purchase. So what is purchase? Only the goods bought by the business is called as purchase. What is goods? Goods are nothing but the things or products with which the business deals. And purchase, goods bought by the business is called as purchase. Purchase returns. Goods returned by the business to its suppliers is called as purchase returns. Sales. Goods sold by the business is called as sales. Sales returns. The goods returned by the customer to the business is called as sales returns. Expense is nothing but the money you spent is called as expense. Income, inflow of money. Whenever you're receiving money, you get money, that is called as income. Or the earnings of the business is called as income. Hope you understand these terms. So moving on to the next one, the most important one, that is the classification of accounts. So we know there are three types of account: personal account, real account and nominal account. So coming for personal account, so these are the accounts of person or partnership firms, companies, schools, colleges, bank. So those are called as personal account. Real account are account of assets. And nominal account are account of expense, losses, income and gain. And the next one, rules for debiting and crediting various accounts. So personal account rule, debit the receiver and credit the giver. And real account rule, debit what comes in and credit what goes out. Lastly, the nominal account rule, debit expenses and losses and credit income and gain. Only when you are thorough with these terms, types of account and its rule, you will be able to understand the journal entries. So before moving on to journal entries, be thorough with these portions and then move on to the next topic, journal entry. So coming for journal. So what is journal? Actually, this journal is a French word. It is derived from a French word. Jour means it's a day. So journal is nothing but, you say it is a day book or a daily record. So it is a book where all the transactions are being recorded. Next, coming for format of journal. Whenever you make any transaction, that will be first entered into this book called journal, and it has its own format. So totally it is having 5 columns. First column is the date column. Second, particulars. Third, LF, which stands for ledger folio. Fourth, debit amount. And fifth, it's a credit amount. The first column, date column. So date column is used to enter the date of transaction. And next column, particulars column. So what is the need of particulars column? See, every transaction, there will be 2 accounts involved. So the name of those 2 accounts will be entered in this particulars column. But which account name should be entered in the first line means it is the account which has to be debited. So in the first line, you're going to write the account which has to be debited, and in the second line, you're going to write the account to be credited. Okay. The next one, you say it is LF, ledger folio. So this is used to enter the page number of ledger of this particular entry. So firstly I said whenever transaction takes place, that will be entered into this book called journal. But later it will be posted into one more book which is called as ledger, and the page number of that ledger will be entered here for easy reference. And the amount of transaction will be entered on the debit side as well as on the credit side. I think you're clear with this. Date column is used to enter the date of transaction. Particulars column, it is used to enter the name of accounts involved in the transaction. So how we are going to enter? The account to be debited will be on the first line, and in the next line you are going to write the account to be credited. And if you need an explanation, a brief explanation about this entry can be done within brackets, and usually it starts with a word called being, and this is called as narration. So this brief explanation about the entry is called as narration. So LF is nothing but ledger folio. Debit, the amount of transaction will be entered on both the sides, debit side and credit side. So we'll see how this has been entered. So first, date column, I said it is used for entering the date of transaction. The column is meant for recording the date as on which a particular transaction takes place. The next one, particulars column, is meant for recording the names of accounts to be debited and credited for a particular transaction. So in the first line, the name of account to be debited is written, and in the next line the name of account to be credited is written after leaving little space to the left to easily distinguish the debit entry and credit entry. So in order to link those two accounts, which is written in two different lines, the word debit is written at the end of name of account to be debited, and the word to is written before the name of the account to be credited. To explain why one account is debited and the other account is credited, a brief explanation, usually beginning with the word being or for is written in particulars column within brackets. This brief explanation to the journal is called as narration. So we know LF, I said it is called as ledger folio, and it is meant for recording the page number of the ledger where the journal entry will be posted or transferred later. It helps in tracing an entry in the ledger easily. And the fourth column, debit, is meant for recording the amount of transaction to be debited. And the fifth column, credit, is meant for recording the amount to be credited. Hope you have understood this. So let's see with example. So first, Uday commenced business with cash rupees 5 lakhs. So in order to enter into journal, firstly we have to find what are the two accounts involved in this transaction. And the next thing you have to do is you have to identify the type of account. And the third thing is you have to apply the rule. Why to apply the rule? To find out which account should be debited and which account should be credited. In the above transaction, how to find the two accounts involved in the transaction, that is Uday commenced business with cash. Here Uday is a owner. He is a proprietor. When the proprietor invests money, what is that money called as? Yes, it is capital. So the capital is one account, and what he is investing? He is investing cash. So the other account will be cash. So the two accounts involved in the transactions are capital account and cash account. So first we found out what are the two accounts involved in the transaction Uday commenced business with cash. So one is commenced business means owner is investing money So that is capital. The other account is cash account. Next, I said we have to find the nature of two accounts involved in the transaction. So we know capital account. First, capital account, what type of account it is? It is a personal account. Why? Because it is account of proprietor, account of a person. That's why you say capital is nothing but personal account. And cash is real account. Why cash is real account? Because cash is an asset, you say it is real account. So next, in order to find out which account should be debited and which account should be credited, we have to apply the rule to this. So we know capital is nothing but personal account. What is the rule for personal account? Debit the receiver, credit the giver. In this case, capital account is personal account and the rule for which is debit the receiver and credit the giver. From the transaction, it is understood that the owner is investing money. So he is a giver in this case. That's why capital should be on the credit side. And cash is nothing but it's a real account and the rule for real account is debit what comes in and credit what goes out. From the above statement, is cash comes inside the business. Owner is investing money for the business. For the business, cash comes inside. That's why it is on the debit side. So hope you have understood. For the transaction, Uday commenced business with cash rupees 5 lakhs. So the two accounts will be capital account and cash account. Capital, it comes on the credit side. Why? Because capital is personal account and by applying the rule, debit the receiver, credit the giver. In this case, owner is the giver. So you put it on the credit side. And cash is real account. Cash comes inside the business. That's why you're putting on the debit side. Let's try to solve this. So first one, Uday commenced business with cash rupees 5 lakhs. Deposited into bank 10,000. Bought goods for cash rupees 10,000. Bought office furniture for cash rupees 5,000. Sold goods for cash rupees 6,000. And sold goods to Murthy on credit rupees 4,000. Paid salary to manager rupees 10,000. Sold office furniture for cash rupees 2,000. Received commission from Suresh rupees 2,000. And withdrew cash from office for personal use rupees 2,000. So let's see how it will be entered in the book of journal. So first one, Uday commenced business with cash. We have already found out what are the two types of account, that is cash account and capital account. And we know cash is on the debit side and capital on the credit side. When we are entering in journal, we know the first line, the account to be debited has to be entered there. That is in the first line. So here comes a cash account debit. And straight to it, you're going to enter the amount of transaction in the debit column. In the next line, leaving some space, starting with the word called to, you're just going to write the other account, that is capital account, that is account to be credited. And on the credit column, you're going to enter the amount of transaction. And in order to explain about this entry, we have done within brackets and it is started with a word called being and this is called as narration. So this is how it will be entered in the book of journal. And to end the transaction, a line will be drawn for the particulars column, not for the entire table. In order to end the transaction, a line will be drawn only for the particulars column. And the next statement, deposited into bank rupees 10,000. So what are the two types of account? Deposited into bank. One is bank account, the other one is cash account. So what type of account is bank? Whether it is personal, real or nominal. So bank it's a personal account. I said it's account of persons or partnership firms, companies, schools, colleges, everything comes under personal account. So bank is a personal account. Okay, cash, we know it is a real account. So personal account rule. What is the rule for personal account? Debit the receiver and credit the giver. So in this case, deposit it into bank. So bank is the receiver or the giver. Because we are depositing, bank is a receiver. We are giving it to the bank. So deposited into bank means bank is a receiver. That's why you are putting on the debit side. Coming to cash account. Cash, we know it is real account. Cash goes outside the business in this case. So real account rule, debit what comes in, credit what goes out. In this statement, cash is going outside the business and that's why it is on the credit side. Hope you have understood this. So the next statement, bought goods for cash rupees 10,000. Bought goods is called as purchase. So one account is purchase account, the other account will be cash account. So next, in order to identify which should be debited and which should be credited, we have to find what type of account it is. Purchase account is nominal account, or you can also say it is real account. Why it is nominal? Because purchase is an expense of the company, you can say it is nominal. But why you say it is real account? After purchasing, it is an asset of the business. It belongs to the business. So you can also say it as real account. So anyways, whichever rule you're applying, it will come on the same side. Let's see that. Suppose if you're considering purchase as a nominal account. So what is the rule for nominal account? Debit all expenses and losses. Purchase is an expense for the company. So it comes on the debit side. And when you consider purchase as a real account, so what is the rule for real account? Debit what comes in. In this case, the goods comes inside the business. You're purchasing goods. So goods comes inside the business. That's why you're putting on the debit side. Clear? Okay. So next, cash account. So when you're purchasing, you're paying the money. It goes outside. So that's why you're putting on the credit side. Applying the rule, debit what comes in, credit what goes out. So cash is a real account. Cash goes outside. So that's why you're putting on the credit side. So the next one, bought office furniture for cash rupees 5,000. So what are the two types of accounts involved here? Is it purchase? No, definitely no. It is not purchase. Why? Only the goods bought by the business is called as purchase. In this case, what we are buying? We are buying office furniture. So the account should be office furniture account and cash account. So office furniture, it's a real account because we know it is an asset. And by applying the rule, real account rule, debit what comes in and credit what goes out. Because office furniture has been bought into the business, it comes inside, so you're putting on the debit side. And cash is a real account. You're buying office furniture for cash. So cash goes outside, so that's why it has been entered on the credit side. Sold goods for cash rupees 6,000. So what are the two types of account? Sold goods is called as sales. So one account is sales and the other account will be cash. Sales account, it is a nominal account. And why we are putting on the credit side? Because sales is an income. Sales account, applying the rule, debit all expenses and losses, credit all income and gain. When you are doing sales, there is an income for you. So income, it has to be on the credit side according to the rule of nominal account. And coming for the cash account, cash is nothing but real account. So debit what comes in and credit what goes out. In this case, you're selling the goods, whereas cash comes inside the business. Cash has been given to you. You're receiving cash. So it comes inside. So that's why you enter it on debit side. Hope you're clear with this. So next one, sold goods to Murthy on credit rupees 4,000. So what are the two types of account here? So one is sales account. The other account is Murthy's account. It is not cash. It is Murthy because it has been sold for credit. So we are taking Murthy's account. So sales, we know it is nominal account, and because it is an income, you're putting on the credit side. And Murthy's account, you know, it is personal account. The name of a person is nothing but personal account, we said. And what is the rule for personal account? Debit the receiver. Here in this statement, Murthy is the receiver. Sold goods to Murthy. Murthy is receiving that goods. So he is the receiver, and that's why you're entering it on debit side. Coming to the next transaction, paid salary to manager rupees 10,000. So what are the two types of accounts involved in this transaction? So first, salary account and cash account. Why don't we take manager's account? Because here the money is being settled. Paid means settled. We have already paid. So there is no need to keep track to whom you have given. So one account is salary account. The other account is cash account. So which should be on the debit side and which on the credit side? So as we know, salary is an expense of the business. So it is nominal account. So rule for nominal account, debit all expense and loss. Salary is an expense. That's why it is on the debit side. And cash account, cash goes outside. Cash account is a real account. Real account rule, debit what comes in, credit what goes out. In this case, cash goes outside. So that's why you're putting on the credit side. Next statement. Sold office furniture for cash rupees 2,000. So what are the two types of account? Should we take it as sales? No. The two accounts are office furniture and cash. Only the goods sold by the business is called as sales. Here we have sold office furniture. So you should take it as office furniture account, and the other account is cash. So office furniture is a real account. So real account rule, debit what comes in, credit what goes out. So office furniture goes outside. So you're putting on the credit side. It has been sold. It is going outside. So that's why it is on the credit side. And cash is a real account. When you're selling, you get money. You receive money. That's why it has been entered on the debit side. The next transaction, received commission from Suresh rupees 2,000. Here the two types of accounts are received commission account and cash account. In this case also we are not going to take the name because receive means he is already given. We have already received. So that's why we are not going to take the name of the person. It's cash account. Received commission, it is nominal account because it is an income. So all incomes will be on the credit side according to the rule of nominal account. That is debit all expenses and losses, credit all income and gain. Cash account. So here cash comes inside the business. That's why you're putting on the debit side. The next statement, withdrew cash from office for personal use. The money which is being withdrawn by the proprietor for personal use is called as drawings. So the two accounts involved here are drawings account and cash account. So drawings account, we know it is personal account. Personal account rule, debit the receiver, credit the giver. Here the owner is receiving money. He takes money from here. So he is not the giver. He takes money. He receives money. That's why it is on the debit side. And cash is real account. Cash goes outside, and that's why we are going to enter it on the credit side. So from the above transaction, come to a conclusion that in case of capital, owner is a giver, and case of drawings, owner is a receiver. So that's why capital is on the credit side and drawings is on the debit side. Purchase is an expense according to nominal rule. Debit all expenses and losses. That's why purchase is on the debit side. Sales, there will be an income for you. That's why it is entered on the credit side. Purchase, sales, both are nominal account. Purchase is an expense you're putting on the debit side. Sales is on the credit side. Is the income, so you put it on the credit side. Purchase returns. When purchase is debit side, is just opposite to it. You remember that purchase return is on the credit side. Sales on the credit side. Sales returns is opposite to that. It is on the debit side. So expenses, we know it is on the debit side. Incomes on the credit side. Assets will be on the debit side and liabilities will be on the credit side. Hope you have understood something. Keep practicing.
That's all for today's session. Thank you for watching this video. If you like the video, give me a thumbs up and make sure you share it with your friends. See you in my next video. Until then, take care and keep smiling.